The global finance storm, Nvidia shock, tariff chaos, gold warning, and the $348 trillion debt bomb. Stop scrolling, because the market just sent a message, and it wasn't subtle. Nvidia posted blockbuster numbers, and the market still sold it. Gold is hovering near record levels like it knows something we don't. Tariffs just kicked in, and trade is turning into a political minefield. And global debt just hit a number so insane, it should honestly terrify every investor on Earth. $348 trillion. Today, I'm going to connect all of it. The AI trade wobble, the tariff regime, the gold signal, the crypto regulation wave, and the debt bomb. And I'll show you what this means for your portfolio in the real world. Watch until the end, because I'm going to give you a simple survival portfolio framework that works even if the next 6 months become chaos. The big question, why the market feels wrong. Let's start with what you're feeling. If you've been watching markets lately, you've probably felt that something is off. It's not a clean bull market, it's not a clean bear market, it's this weird, twitchy, unstable environment where good news doesn't always lift stocks. Bad news sometimes explodes into panic, and every week feels like one headline away from a new regime. That is not your imagination. That's what happens when markets enter a transition phase, when the old story is dying, but the new story isn't fully born. And right now, there are 4 major narratives fighting each other. 1. AI miracle growth versus AI bubble fatigue. 2. Trade and tariffs reshaping profits and inflation. 3. Safe haven flows screaming caution, gold. 4. Debt levels so extreme that central banks have almost no room to make mistakes. If you understand how these 4 forces connect, you stop reacting emotionally and start positioning strategically. So let's walk through the evidence from yesterday and today. Nvidia, the most important tell in the entire market. Let's talk about the moment that should have shocked everyone. Nvidia reported strong earnings and outlook, and the market still punished the stock. That's not just a stock move, that's a psychological event. Because Nvidia isn't just any stock anymore. Nvidia is the symbol of the AI boom, the engine of AI infrastructure spending, and the proof asset for the idea that AI will justify massive valuations. But what happened? Reuters noted US stocks turned lower, with the Nasdaq down about 1.2%, as Nvidia's results failed to impress investors and dragged tech lower. Investopedia also described Nvidia falling over 5% even after a strong report, reflecting investor doubts about how long the AI growth wave can last. This is the key takeaway. When markets stop rewarding great news, it means expectations have become dangerous. Because if investors are already priced for perfection, then even perfection isn't enough. And that's when you get fragile price action. Think of it like this. If a stock needs a miracle just to hold its price, what happens when the miracle becomes normal? You get rotation, re-rating, and sudden violent sell-offs when something cracks. Now, I'm not saying AI is dead, not at all, but the market is starting to shift from AI will save everything to, okay, show me the cash flows, show me the sustainability, show me who survives the CapEx arms race. That shift matters because it changes what gets rewarded. Not hype, but margin stability, cash generation, pricing power, and balance sheet strength. Keep that in your head. We're going to connect it to tariffs and debt in a second. Tariffs, the hidden inflation engine nobody's pricing properly. Now we move to the next major force, tariffs. The Guardian live coverage reported new global tariffs kicking in at 10%. And the Washington Post analysis described a Supreme Court decision enforcing a universal 15% baseline tariff, which changed the whole game for countries that thought they had negotiated special treatment. This matters because tariffs are not just politics. Tariffs are an economic weapon, and in markets, tariffs behave like attacks on supply chains, attacks on margins, and often attacks on consumers through higher prices, which leads to the most important phrase in investing. Tariffs can become sticky inflation, not always immediately. Sometimes it creeps, because if companies can pass the cost to you, they do. If they can't, they eat it, and margins shrink. Either way, someone pays. Now here's the crucial part. When tariffs rise, inflation doesn't need demand to rise. Inflation can rise because inputs are more expensive. And that's how you can get the worst combo. Growth slowing, inflation staying stubborn, central banks stuck, and markets repricing risk. That's why this tariff story is not a minor headline. It's one of the key mechanisms that can keep interest rates higher than investors want. And when rates stay high, that brings us to the next monster. The $348 trillion debt bomb. Why this is the real story. Now we hit the big number. The Institute of International Finance reported global debt hit a record $348 trillion by the end of 2025, with roughly $29 trillion added in 2025, the fastest annual increase since the pandemic-era surge. Let's translate that into plain English. The world borrowed almost $30 trillion in 1 year. That is not normal. That is not sustainable forever, and it changes how markets behave. Here's why. Debt is manageable when growth is strong, borrowing costs are low, and confidence is high. Debt becomes dangerous when growth slows, borrowing costs stay elevated, and confidence fractures. And right now, we have rising geopolitical tension, tariff uncertainty, and an AI-driven productivity revolution that is also an employment disruption machine. That creates a new risk. Debt makes the system sensitive. In a high-debt world, small shocks create outsized consequences. A small move in rates can blow out budgets. A small drop in growth can widen deficits. A small tariff shock can ripple through supply chains and earnings. And once debt reaches these levels, central banks lose options. They can't easily hike without breaking something. They can't easily cut without risking currency weakness and inflation. So the system becomes fragile. And fragile systems don't collapse every day. But when they do, they move fast. Gold, the market's lie detector. Now let's look at the asset that doesn't lie. Gold. Reuters reported gold around $5,180 per ounce, supported by falling treasury yields and ongoing uncertainty, including US-Iran nuclear talks and tariff uncertainty. Bloomberg also described gold near $5,170 per ounce, with traders focused on US tariffs and Iran talks. Gold is doing what gold does when the world is unstable. It quietly becomes a magnet for capital-seeking insurance. Now here's the real point. Gold doesn't need you to believe in it. Gold is the asset that responds when confidence in policy falls, confidence in currencies weakens, and geopolitical risk rises. And when gold is elevated while equities feel twitchy, it suggests that smart money is hedging. It doesn't mean the apocalypse is tomorrow, but it does mean the market is not fully convinced the current regime is safe. Gold is the smoke. Debt and tariffs are the fuel. Now let's bring crypto into the story, because crypto is becoming the most misunderstood macro asset on Earth. Crypto is being absorbed into the system. Genius Act. Here's what's new and important. The Genius Act created a federal framework for payment stablecoins, and regulators are now putting out proposed rules and licensing structures. This matters for your audience because stablecoins are not crypto toys anymore. Stablecoins are becoming a regulated payment rail, a settlement layer, and a bridge between traditional finance and digital markets. And as regulation becomes clearer, big institutions can step in with less legal uncertainty. Now, you might be thinking, okay, but why should I care? Because this is how financial systems evolve. At first, new systems are ignored. Then they are mocked. Then they are feared. Then they are regulated. Then they are absorbed and monetized by institutions. Stablecoins moving into a formal framework is a sign that crypto isn't disappearing. It's becoming infrastructure. That doesn't remove volatility. Not at all. But it changes the long-run trajectory. It means that when liquidity returns, crypto can become a risk-on rocket again. And that brings us to the core problem. The market can't decide whether we're in a risk-on boom or a risk-off storm. The regime split. Why markets look schizophrenic. Let me explain the current market environment in one phrase. We are in a regime split. Two types of investors are reacting to two different futures. Future A, soft landing, productivity, boom. AI increases productivity. Inflation gradually cools. Growth stabilizes. Markets rally on innovation. Future B, sticky inflation, trade friction, debt stress. Tariffs keep costs elevated. Debt forces policy traps. Growth slows. Markets reprice risk hard. And both futures have evidence. That's why you see Nvidia beats but still sells off. Expectations too high. Gold staying elevated as a hedge. Tariff regime uncertainty, reshaping costs. Debt exploding in the background. Crypto regulation, normalizing stablecoins. So the market isn't irrational, it's divided. And in divided markets, the best strategy isn't prediction, it's positioning. But before we get to the strategy, we need to address one more element your audience will love: jobs. Because AI plus tariffs plus debt are not just charts, they hit people. The silent crisis, jobs, offshoring, and AI efficiency. The Guardian reported companies like Ocado cutting jobs as part of cost savings tied to AI-driven efficiency and broader commentary around AI reshaping labor. The Guardian also highlighted Whirlpool workers upset about job cuts and offshoring, despite tariffs meant to protect manufacturing. You see the contradiction? Tariffs are sold as protection, but companies still chase cost advantage, restructure, automate, and relocate. This is why your AI will run finance theme lands. Because what people are feeling is not just market volatility, it's insecurity. And insecure populations behave differently. They spend differently, vote differently, invest differently, and demand different policies. That feeds back into markets. Now let's tie everything together with the storm model. The storm model. 5 forces converging. Force 1, AI trade fatigue, even after strong results. Nvidia showing that great isn't enough anymore is a major psychological shift. Force 2, tariff regime uncertainty. 10% tariffs kicking in, with the 15% baseline concept changing global expectations. Force 3, debt at extremes. $348 trillion. Global debt means small shocks become big events. Force 4, gold as a confidence hedge. Gold elevated as yields fall and geopolitics simmer. A classic risk insurance bid. Force 5, crypto being absorbed by regulation. Genius Act framework plus proposed rules mean stablecoins are moving into mainstream rails. When these 5 forces align, you get higher volatility, sudden rotations, and a market that can rip up or crash down on headlines. Now, the most important part. What does an ordinary investor do? I'm going to give you a framework you can follow without being finance professionals. The Survival Portfolio Framework, beginner-friendly. I'm not a financial advisor. This is education. But here's the framework I use for high-uncertainty regimes. Step 1, build a 3-bucket portfolio mindset. Bucket A, resilience, boring but strong. Quality cash flow businesses, defensive sectors, strong balance sheets, pricing power. Bucket B, insurance, when the system gets weird. Gold, precious metals exposure. Cash buffer, maybe short-duration bonds depending on rates. Gold has been acting like insurance for a reason. Bucket C, optionality, asymmetric upside. Select AI infrastructure winners, not hype, real revenue. Bitcoin crypto exposure, sized responsibly. Innovation with risk control. And here's the rule. Bucket C should never be so big, it can destroy your life if it collapses. Step 2, don't confuse exciting with safe. In late-stage narratives, the most exciting assets are often the most fragile. That's why Nvidia selling off despite strong results matters. It suggests the narrative is crowded. Step 3, respect liquidity and avoid leverage. Debt-heavy systems punish leverage brutally. When volatility spikes, leveraged investors become forced sellers. Forced sellers create cascades. Step 4, watch macro tripwires. You should watch tariffs expanding or being retaliated, bond yields breaking down or spiking, gold making new highs, risk hedging intensifies, regulatory headlines in crypto, institutional flows. The 2 scenarios. Scenario 1, AI boom continues, volatility fades. Nvidia and tech stabilize after the post-earnings wobble. Tariffs don't escalate further, rates drift lower, risk assets resume uptrend. Scenario 2, sticky inflation plus trade friction plus debt stress. Tariffs raise costs. Inflation stays stubborn. Central banks can't cut aggressively. Growth slows. Markets reprice valuations. Both scenarios are possible, but your portfolio should survive either one. The real risk isn't that markets crash tomorrow. The real risk is that we enter a decade where policy is unstable. Trade is weaponized, debt is unmanageable, and AI accelerates the speed of everything. And in a world like that, the old middle-class strategy of work, save, pension, retire becomes less reliable. So people will do what they always do under uncertainty. They chase alternative stores of value, alternative systems, and alternative upside. That is why gold remains elevated. That is why crypto infrastructure regulation matters. That is why markets react violently to AI sentiment shifts. And that is why debt is the silent villain. If you want daily updates like this, the real story behind the headlines, subscribe. And comment below one word, storm, if you think the global financial storm has already begun. Or soft, if you think we still get a soft landing. I'll pin the smartest one. Stay sharp, stay diversified, and remember, when the headlines finally admit what's happening, the best opportunities are already gone. Stay awake, stay aware. This is Felix. See you in the next one.